Hey, what's up, guys? My name's Charlie, and I want to help you build wealth in real estate. Real estate can be a phenomenal investment vehicle if you know what you're doing. The problem is it's really risky and can be extremely confusing. So I'm here to demystify real estate, and I'm here to help you build wealth. All right, guys, what's going on today? Hope all is well. Today, we are going to talk about interest-only loans. There's benefits and there's negatives to that. A lot of investors actually like interest-only loans because it can provide more cash flow. And we're going to look at an example here. Let me share my screen. A lot of interest-only loans, they can be floating rate, so interest rate is not fixed, so it will vary. A lot of commercial investors love interest-only loans, or at least loans with interest-only periods, because it does provide better cash flow. And let's just look at a quick example here. So we're going to look at a property that is $300,000. That's the purchase price. There's a down payment of $30,000, which is 10%. And we're going to look at only for the mortgage payment, we're only going to look at the principal and interest. We're not going to include property taxes. We're not going to include HOAs or insurance in this example. So the down payment is $30,000. So that means in both cases, you have a normal 30-year loan here that is amortized over 30 years. And then on the right side in red, you have the interest-only loan. And so the down payment is going to be, in both cases, same home, same down payment. We're just going to look at a normal 30-year fixed loan versus an interest-only loan. Interest-only loans are typically going to have a higher interest rate. In this case, I believe I used like a 6.7 interest rate. And in this case, I used a 7% interest rate. The interest only, if we look over here, you're paying the principal and interest. And so over time, you pay a little bit of principal. So your loan balance every single month, every time you make a mortgage payment, goes down and down and down just slightly. Whereas on the interest only side, that principal remains the same. You're only paying interest. Over time, if you had this loan for 30 years, you would actually pay off this home in 30 years. Where if it was an interest-only loan for 30 years, which I don't know if those even exist, but you would still owe $270,000. You would still owe all of that principal because you're not making payments towards the principal in an interest-only loan. You're only paying interest. So if we look at the mortgage, a normal 30-year mortgage, you're paying about $1,742 a month. Whereas on an interest-only loan, you're paying $1,575. So you're paying a little bit less. After 3 years, you're $270,000, and I just realized I made a mistake here. You're after 3 years, you owe about $261,000 on this loan on a normal 30-year fixed loan. With interest only, you still owe the same amount that you owed 3 years ago because you're only paying the interest. So why do investors like this route? Why do investors like this interest-only route? Well, the big thing is the cash flow. The cash flow, the difference here is $167 per month difference. And so if we take that number, 167, and let me do it up here, we take $167 a month times 12 months, you're coming out with a difference of $2,004 a year. And if we multiply this number by 3 years, that's a $6,000 difference in cash flow. So that may not seem like a lot to some people, but investors love this strategy because they're focused on the cash flow. And what they'll do with this $2,000 a year is maybe they'll use it to fix up the property. Maybe they'll reinvest that money into other properties. One property may not seem like a big deal, but if you do this over and over and over, that $2,000 a year, let's say you have 10 properties, that's $20,000 a year in cash flow. If you use the interest only model, as opposed to the typical 30-year fixed rate. And so that can add up very quickly. Now, the downside, of course, is when you go to sell the property, you still owe $270,000 on the interest only loan. Whereas with a normal 30-year fixed rate loan, you owe about $261,000. So investors like the cash flow today versus a bigger check in 3 years, 4 years, 10 years, whatever it is, because they're able to reinvest that additional cash flow every month or every year. They're able to buy more properties. They're able to scale a little bit quicker. So there's benefits to an interest-only loan. There's negatives to an interest-only loan. In apartments, we actually like interest-only loans because it actually, again, does provide a better cash flow. And in our case, we're not buying properties that are $300,000. We're buying properties that are $20 million, maybe $30 million, $50 million. So this cash flow isn't 167. By the way, this is a month. This is not a year. So let me add that. But on apartments, we may get an extra $10, $20, $30,000 a year because it's an interest-only loan. And because we have so many investors, our job is to give them their money back as soon as possible, as much money back as soon as possible. So we actually, instead of going this fixed rate route, we look for interest-only periods. And so that interest only allows us to give them more money back sooner. Now, the downside of that is after 5 years or after 10 years, they're actually making a little bit less because we're not paying principal. So we are paying more in interest over that period, but they're getting their money back sooner. And our investors like they like the passive income. Some of them live off that passive income and reinvest when the property sells. And some of them reinvest before the property sells. They take their cash flow and they reinvest it sooner rather than later. So I hope you like this video on interest only versus a typical 30-year amortized loan. Again, there's benefits to both sides. There's negatives to both sides. Our investors like the interest only period because it gives them more money back sooner, and they take the hit in the long run. And it's not a huge hit either way, but they just like to reinvest that money, get the money back sooner rather than later. And that way they can reinvest and help scale and build their portfolio, and they can help build and grow their wealth sooner. Hope you liked the video. Don't forget to like, subscribe, leave a comment. Thank you.